So speaking of the possibility of whether or not we are going to see a recession, it hasn't looked like we are in one with at least some of the recent data that we're following. That January retail sales report that we got out, smashing Wall Street's expectations, the labor market producing 500,000 jobs, and stocks have rebounded to start the year. Equities off to a very strong start since January 1st. So joining us now to discuss why this recession talk isn't playing out in the data or investor portfolios, some investor portfolios, we want to bring in Cameron Dawson, NewEdge Wealth Chief Investment Officer. Cameron, it's great to see you here. So weigh in. A hard landing scenario, no landing, soft landing. What do you think and why?
Well, I think, Shauna, your point was really, really good about just because we don't have a landing in the short term doesn't mean that a hard landing or a soft landing won't happen at some point in the future. What we think essentially has been happening is that better data today has been pushing out the recession scenario from 2023 into 2024. And if that's the case, what you might see is a little bit better earnings growth from companies just because growth doesn't fall off a cliff. But to your point, it keeps the Fed tighter and higher for longer, which should put downward pressure on those valuations. So it could end up being a bit of a wash for equity markets.
Before we push all the way out to 24, and I do want to circle back to that, are we in line for a 50-point hike at the next meeting?
Well, that's what Mester said yesterday and Bullard as well. I don't know if it actually happens, but they're floating it out there essentially as a way to talk down easing financial conditions, which may be one of the reasons why we're seeing this reacceleration in growth. So the market isn't fully pricing in a 50 basis point hike in March, but you're seeing that probability rise as each successive day of hotter data comes in. But we're also seeing the probability of another hike in June rise. It's now about a 50-50 probability. So if you compare that expectation to just 3 weeks ago, when a lot of people were expecting January to be the last hike, the world has changed really significantly to really reflect the reality of the Fed staying tighter and higher for longer.
Yeah, Cameron, how much of that risk there do you think is already priced into the market? And if not, what does that then mean for equities here over the next couple of months?
Well, at 18 and a half times earnings, we don't think that the market from an equity perspective is pricing in that higher for longer rates. Mostly if you consider those growth stocks, which are the most sensitive to rates, the NASDAQ's still trading at about 26 times earnings. So that's clearly not reflective of where yields are today and importantly, where real yields are today. So because we've seen this big rally off the lows in October that has been completely driven by valuations are now at a level that we would consider risky as long as interest rates stay at these elevated levels.
And what's been your lesson thus far from these latest earnings reports?
Well, it continues to be all about cost control for companies, really wanting to tighten the belt in order to defend margins. What's interestingly, it hasn't quite been enough to defend margins. So if we look at revenues, they grew about 4% for the quarter, but overall EPS is down 3 to 4%. And that's because we've seen about 100 basis points of margin compression. We think that's the real risk for 2023 earnings, is just that even if we see a little bit better top line because the economy is better, that margins still have room to fall back to pre-pandemic levels, which could just mean lackluster earnings growth for the year, despite the fact that we don't actually have a recession.
So Cameron, what does that mean for investors? What should they be doing at this point, given all of that uncertainty and then the risk they're looking out into 2024?
Yeah, we've stuck to our quality bias to begin this year. It certainly caused us to lag in performance because we have seen a lot more of the performance, the strong outperformance from the most speculative, kind of lower quality parts of the market. But as we look into the 2023 and 2024, as long as the Fed stays in this tightening policy, we think economic uncertainty will be high. So we want companies that can generate strong returns on invested capital, that can generate a lot of cash that they could then return to us as shareholders. And we really want strong balance sheets. One of the things that we've saw over the past couple of months as financial conditions eased is that poor quality companies were able to go to the debt market and borrow again. But if we see financial conditions tighten, those poorer quality companies won't have access to the capital that they need. And thus we could see the stocks underperform. So we're sticking with that quality bias. We like it for the long run. And if those names lag or underperform, we'd see it as an opportunity to build into positions.
Promised I'd circle back to 24, so that's where we finish. Is your base case that hard landing scenario in 24?
I don't think we have enough evidence of that yet. I think it would be a lot to assume that we don't have some kind of landing in 2024, given the rapidity and the magnitude of the Fed's hiking cycle. Just that every time that the Fed hikes, we typically do see some economic weakness, but it is hard to put a pin into today exactly how deep that weakness could be. But I think if we contrast that to where the street has earnings estimates for next year, the street's sitting at about $245, $250 a share for 2024 earnings, which is essentially pricing in a really rapid rebound in earnings growth to low double digits. If a hard landing is actually a risk for 24, those estimates are far too high. And so it really will be interesting to see how we balance the path of 23 as we go into 24 to really get at the right number for that 2-year ahead forward EPS.
Certainly will be. Cameron Dawson, great to have you. Thanks so much. Have a good weekend.